Welcome to this explainer. There is one major question on the minds of a lot of residents lately, and it's a completely fair one to ask. Exactly how is Shasta County spending its money, and where is it all going? It often feels like a giant confusing maze. So today, we're going to completely demystify county finances, follow the actual money trail, and look at how this massive system functions behind the scenes.
Okay, let's dive right into this. $685 million. That is the massive total budget for Shasta County for fiscal year 2025-26. When you hear a number that huge, it's incredibly easy to assume the county just has endless resources to fix every single road, fund every community project, or solve whatever local issue pops up. But to really understand financial management at the county level, we have to look past the sticker shock of that top-line number.
To do that, we're going to use a top-down funnel approach. First, the $685 million question. Second, where the money comes from. Third, major funding destinations. Fourth, enterprise funds explained. And finally, the discretionary squeeze.
Starting off with Section 1, the $685 million question, and understanding the scale of this thing.
Honestly, the best way to look at this is through a household budget analogy. When you get your paycheck, you don't actually get to spend all of it on whatever you want, right? A huge chunk is already legally spoken for. Taxes are deducted automatically, then you've got your rent or mortgage, utility bills, groceries. Well, the county operates in the exact same way, just on a much, much grander scale. This massive county budget isn't some endless pool of discretionary cash. The vast majority of it is completely restricted by law before it even hits the county's bank account. Moving to Section 2, where money comes from. Specifically, external revenue sources.
A really huge piece of this puzzle is something called the 1991 realignment. Now, I know that sounds like total bureaucratic jargon, but it's absolutely crucial. Basically, a portion of the state's sales tax and vehicle license fees that citizens pay goes straight to the state, and then the state sends it back to Shasta County. But there's a massive catch here. These funds are legally dedicated specifically to public health, mental health, and social services. For Shasta County, these state funds provide the absolute majority of matching funds for local programs. That means the county literally has zero choice but to spend this money exactly how the state dictates.
Now, what's really interesting about this slide is just how incredibly rigid these funding structures are. Take child support services, for example. The primary source of funding to support their operations is a strict split, 66% from the federal government and a 34% state share of cost. But to actually get that money, the local agency has to be in strict compliance with federal Title 4D program standards. Or look at mental health. The county actually has to make a statutory maintenance of effort contribution from its own general fund just to receive the state realignment money. This leaves no room for local diversion at all. The county is essentially just acting as a pass-through for these federal and state mandates.
Which brings us to Section 3, major funding destinations, or answering the big question of where the money actually goes.
These numbers right here are pulled directly from the county's financing schedules, and they show the sheer staggering scale of these mandated costs. Social services alone accounts for over $107 million. Public safety is sitting at nearly $61 million. Roads take up over $31 million, and mental health tops $25 million. So when people ask, where's all this money going? Well, this is your primary answer. The absolute lion's share is instantly swallowed up by the unavoidable costs of running mandated social, health, and safety programs.
And this brilliantly illustrates the unpredictable nature of county spending. What we're looking at is a note from the county budget detailing a highly complex securities fraud case being handled by the district attorney. The county had never actually defended a white-collar crime of this magnitude before. Because they suddenly needed out-of-state expert witnesses and professional forensic accountants, the department required an unexpected additional general fund allocation of $250,000 just to prepare for the trial. Unplanned, mandatory justice costs like this pop up out of nowhere and simply have to be paid, which further drains resources.
Section 4, enterprise funds. Let's talk about self-sustaining ops.
So, an enterprise fund is essentially a business run by the county. They're self-sustaining operations funded entirely by the fees paid by the people who actually use the service. It is super critical to understand here that your everyday general taxpayer dollars are not footing the bill for these specific services. They operate in their very own, totally separate financial ecosystem within that total $685 million budget.
For example, let's look at the Fall River Mills Airport. This facility doesn't drain the general fund. Instead, it pays for its own operating expenses through direct user fees. The budget schedules clearly show revenues coming in from land rent, hangar rentals,
airplane tie-downs, and aviation fuel sales. Basically, the people utilizing the airport are the ones paying to keep the lights on and the runways maintained.
Another massive example is solid waste disposal. Managing a county's trash is incredibly expensive. We're talking millions of dollars for heavy equipment, landfill maintenance, and strict environmental compliance. But again, this is an enterprise fund. It's kept running independently by charges for services, specifically tipping fees at the dump, collector fees, and septic fees. Ultimately, if you don't use the dump, your general tax dollars aren't paying for it.
Section 5. The discretionary squeeze. After all of that, what is actually left over?
We have to contrast these two completely different realities. On one side, you have restricted funds, the grants, the realignment money we talked about, the enterprise fees. The county's Board of Supervisors has almost no say in how this money is spent. Their hands are completely tied by law. But on the other side, you have discretionary funds. This is the general tax revenue that the board actually controls and can freely spend on local priorities.
So, the crucial point is this, and this is the big takeaway. Out of that massive headline-grabbing $685 million budget, only about $73 million is actually discretionary. That is roughly just 10% of the entire pie. 90% of the county's money is legally locked into restricted mandates and self-funded operations before the year even begins. When residents demand new infrastructure or expanded community programs, the Board of Supervisors isn't divvying up the whole pie. They are fighting over how to slice up that tiny 10% sliver.
And that leaves us with an incredibly difficult reality to ponder. The county recently put out a public survey asking residents exactly this question. Knowing that only 10%, or $73 million, is actually available for the board to directly allocate to core services like public safety, health, infrastructure, and community programs, how would you rank them? When every single dollar of that 10% is highly contested, what should be the true top priority for your community? It's a fascinating look at the tightrope of local government finance. I really hope this explainer has given you a much clearer lens to view how your county operates and where the money actually goes. Thanks for joining me.